Today's cardinal lesson is going to talk about hybrid life and long-term care insurance. Or in other words, it's a different way to protect yourself so that as you age, if you need help and you need care and you want to do it in your own home, that the resources are there that you can hire it privately. And this product was really invented, this type of insurance. It was created by the government and their tax laws in that it put in the Pension Protection Act a rule that said the tax-free death benefit of life insurance. I mean, life insurance has enjoyed tax-free death benefits since its inception. And this was added to the long-term care benefits on a life insurance policy. So in other words, you have a life insurance and before you die, obviously, you need long-term care coverage and you need to collect from that. Is they set it up in the tax code so that you can pull money out of this, use it for long-term care and not have to pay taxes on it. So that is kind of in its formation. And the reason the insurance companies designed this is with traditional long-term care insurance, one of the biggest stop signs for people is that I'm going to pay this premium, or they tell me a story about some relative that's older that passed away that paid 20 years of premiums for several $100s a month, and then they died and they never used it for a day of long-term care. They were only in the place for 2 weeks. And so there's simply saying I don't want to buy long-term care insurance because I'm just throwing my money down the drain if I don't use it. And it's not a completely logical argument, but if it's people's argument and that's their story, this addresses that to a degree. So what you're doing is a hybrid is the putting together of two things. And in this case, it's a life insurance policy, and a life insurance policy has a death benefit. So when you pass away, there's a large sum of money that goes to your beneficiaries. So we're mixing that, and then we're mixing a long-term care insurance policy that pays out very similar to traditional long-term care, but it's going to do that by just accessing the death benefit early. So what some of the early adopters of this, went through and they talked about live, die, or quit. It's kind of a tough way to look at it, but with hybrid life long-term care insurance is if you live and you live a long time, you're probably going to need care and you're going to be real glad you bought this policy, like any long-term care policy, because you're going to collect way more out of it than you put in it. So we got that one covered. If you die, which we're all going to die, but if you die prematurely without ever using it or just using a little bit of it, then you'll collect for the little bit and then the bulk of the benefit of the policy will go to your estate. So it would just add a happy ending to that story of the person that paid forever on this thing, didn't use it much or didn't use it at all, and when they die, it pays a life insurance benefit to the beneficiaries. So it seems to make sense. Typically, though, logic doesn't sell long-term care insurance. I've been offering this for almost 45 years, and it's logic, and I've just appealed to you with logic. Generally, people will not buy long-term care insurance until they're really committed to the fact that they have a problem. And so we're financial planners. We bring in people for retirement planning who a lot of times are in their 60s, late 50s, early 70s, somewhere in that zone. And we need for them to accept that this could happen to them. And if it happens to them, that it's going to be, the consequences are going to be devastating to their family and to them if they're not properly planned for long-term care. So I really need people to accept that and be on board that, look, we want to find a solution, then this is an option. Now, people can look at this and they can say, well, you know what? This hybrid long-term care, that's just for rich people. I don't have that kind of money, so to pay more than I would have to, and I start throwing out some larger numbers. And certainly this is attractive to wealthy people because people that have money, it just makes sense to take part of that, move it from where it is, put it with the insurance company. They still own it. It's still their money. And they could go get it if they wanted to, but it provides a whole comprehensive plan for long-term care and reimburses them and their estate. A lot of wealthy people do buy this, but it's not only for wealthy people. I have several, one client we were talking about earlier is a school teacher, and she bought this form of long-term care insurance mainly because she couldn't stand the monthly premium going on into the future. And she had a small savings, at least small to her. She had a little over $100,000. She was in her 70s, and it's sitting in the bank, and it's for her daughter. And so her thinking is that I'm going to put it, this lady bought Medicare supplement insurance from us, and as she's talking to me, I'm saying, well, what's that money for? She says, that's going to go to my daughter. Well, why don't you give it to her now? Well, I can't do that. Well, I might need it. Well, yeah. What would you need it for? You haven't spent it this long. You've gone through retirement, and you certainly can't afford that extra money every month into the future. She's in good health. And so we were able to take a piece of the $120,000. We left some of it there in the bank for emergency fund, but we took a good sum of it, moved it to the insurance company, put it into one of these. She had no ongoing premiums, and then it sits there. She hadn't used it yet, but it's grown some, and it's just a benefit that if she needs long-term care, first of all, her daughter's going to be real happy that she bought this, because this is going to be her daughter's problem if she needs long-term care. Then the second thing about it is the daughter is going to get the proceeds of the thing, because it's live, die, or quit. And the quit part is if she really wanted to go get that money that's in that insurance policy and get it out, she'd have to end her long-term care insurance, but it's just like savings in the bank. You could go get it or pull out part of it if you really needed it. So there's some other features with this hybrid thing, is that the premiums cannot increase, because life insurance premiums are fixed right from the beginning. And so the life insurance piece of this gives people a guarantee that you're not going to have premiums are fixed right from the beginning. I have this type of insurance myself, and that was one of the attractive features. I know exactly what it's going to be. I'm not going to be at a ripe old age and then they're increasing my premium. The tax-free death benefits, and then it is possible, and we have several companies that we can work with an annuity instead of the life insurance policy. So we create a cash value in an annuity through your deposit. And you say, well, why would you want to do that instead of life insurance? Well, there's some people with health conditions that can't buy regular long-term care insurance. They can't buy the hybrid life long-term care, but they can get an annuity hybrid, which is, with an example, like $120,000 that this couple put in there, and the first $120,000 is basically being doled back to them at the rate of $5,000 a month for 24 months. They've got a long-term care benefit that either can use, and then when they blow through their own money, there's this extension rider that kicks in at the 25th month of care, and it goes on for years, where either one can access it. So they're effectively buying insurance that uses their own money first. When that's blown through by either partner, then they kick into the real insurance that could carry them on for years. And we can get people with health conditions that can't qualify for other things. We use annuities for that. So I'm Hans Scheil, and I thank you for listening.